What are the best practices for handling the wash sale rule? If you are trading stocks or options, you might have heard about the wash sale rule. This rule can impact your tax deductions, so understanding how to manage it is essential. Let's break down the best practices for handling the wash sale rule effectively. First, know what a wash sale is. A wash sale happens when you sell a security at a loss and then buy a substantially identical security within a 61-day window. This window includes 30 days before the sale, the day of the sale, and 30 days after. If you trigger a wash sale, the Internal Revenue Service disallows the loss for tax purposes. Instead, the loss gets added to the cost basis of the new security, delaying any tax benefit until you sell that security in a non-wash sale. Understanding the term substantially identical is key. For stocks, it usually means the same company's stock. For options, it can be trickier. Buying a call or put on the same underlying stock with similar strike prices and expiration dates may trigger the rule. Always assess if the new position closely mirrors the old one. Remember, the wash sale rule only applies to taxable accounts. It does not affect tax-advantaged accounts like individual retirement accounts or 401(k) plans. However, if you sell a security at a loss in a taxable account and then buy the same security in a tax-advantaged account, it can still trigger the rule. Now let's talk about practical steps. First, keep track of all your trades. Maintain clear records of buys and sells, including dates and amounts. This will help you spot potential wash sales and manage your tax reporting accurately. If you sell a security at a loss, consider waiting at least 31 days before repurchasing the same or a substantially identical security. This will ensure that your loss remains deductible. If you want to stay invested in a sector, think about buying a different but similar security. For example, if you sell one technology stock at a loss, you might buy another technology stock that is not substantially identical. Always consult a tax professional for specific advice. When it comes to options, be extra cautious. Selling a call or put at a loss and then reopening a similar position on the same underlying stock within the wash sale window could lead to a disallowed loss. The Internal Revenue Service looks at the economic substance of the positions, not just their labels. Also, be aware that the wash sale rule can apply across accounts owned by you and your spouse. If one spouse sells at a loss and the other buys the same security within the window, the loss may still be disallowed. Brokers must report wash sales on Form 1099B for stocks and exchange-traded funds, but not for options or transactions across different brokers. It is your responsibility to track and report these accurately on your tax return. If you do trigger a wash sale, remember that the disallowed loss isn't lost forever. It gets added to the cost basis of the new position. When you eventually sell that new position in a non-wash sale, the adjusted basis will affect your gain or loss calculation. Avoid common mistakes like assuming the rule doesn't apply to options. Many traders overlook that options can trigger wash sales if they are substantially identical to the original position. Also, do not ignore the 61-day window. The rule covers 30 days before and after the sale, not just the days following the sale. By following these best practices, you can manage the wash sale rule effectively. This will help you avoid unexpected tax bills while maintaining flexibility in your trading strategy. Understanding these details is especially important for active traders and those using options, where positions can change quickly.